Good morning, everyone. Today is September 24th, and this is the investment meeting of the New York City's Employees Retirement System, taking place at 335 Adams Street, Suite 220 in Brooklyn. Welcome. Madam Executive Director, would you please call the roll?
Okay, Chair, here. Controller's Office,
Here.
Public Advocate's Office,
Here.
Borough President Manhattan,
Here.
Borough President Brooklyn,
Here.
Borough President Queens,
Here.
Borough President Staten Island,
Present.
Borough President Bronx,
Here.
International Brotherhood of Teamsters,
Here.
Transport Workers Union,
Here.
District Council 37.
Here.
We have a quorum.
Thank you. We have an ambitious agenda today on pages 1 and 2 of our board book. Does anyone have any changes to the order of the agenda or requests for additions? All right. Then Larry, I will turn it over to you.
Thanks. So we have a quarterly and annual review. Martin will lead it off.
Good morning. Yes, quarterly report. I do have one extra here.
No, she meant, that's what's that order.
So this is the quarterly report for the quarter ending June, which is also the fiscal year end, so it's an important document. Larry's after this is going to go through the July numbers and a hint of August. But the June quarter, as Larry mentioned last meeting, that was the quarter where market sentiment shifted significantly. The Fed started using the word tapering, entering that into our financial lexicon, and that means effectively that they're considering slowing down to eventually stop their bond buying purchases, or QE. The news of that towards the end of May and into June caused tremendous market volatility, spike in long interest rates, and quite frankly, a decline in most every risky asset class. Correlations spiked up everywhere. But most acutely, it affected interest rate sensitive products, obviously, such as treasuries, government bonds, our Core Plus 5, TIPS, REITs, and even emerging market equities. However, for the fiscal year, while the bottom of that volatility occurred right at the end of our fiscal year, we still have very good fiscal year numbers, as you see if you turn to page 7. So for the quarter, that's on the left, because of the scale of the chart, it's hard to see the numbers. The returns were effectively flat, behind the policy benchmark of just 7 basis points. But for the fiscal year to date, and then those next two columns are the same because it's the fiscal year to date and the 1-year number, the returns were just off of 12 and a quarter, 12.24, 67 basis points ahead of the policy benchmark, and the return for 3 years was 11.87 behind the policy benchmark of 12.59. The 10-year number is at 7.45%. So it was a very good year, mostly from, as you'll see later on, from the equity and risky assets in the portfolio. Turn to page 9. This is a chart you'll see later for July as well, and you see this every month. Top part is the asset allocation. We have a lot of slices, but the largest portion is in green, which is U.S. equities. And the important part is on the bottom part of the page, which shows the mix of assets versus policy and the rebalancing ranges. And the large differences versus policy are fairly obvious on this page. On the left side, you'll see green. That's an overweight to U.S. equity. In the middle of the page, you'll see light blue and I guess light purple. Those are underweights to Core Plus 5 and TIPS. All three of those were additions to the portfolio because U.S. equities did very well. Core Plus 5, as you'll see, did not, and TIPS did even worse. And so being underweight the worst performing asset classes and overweight the best performing asset class helped. To show that on page 10 for attribution, and again, Callan's going to go through this as well, you'll see that the return was just minus 13 basis points, nothing much about that. It was fairly flat, but if you take a look, the allocation effect was 46 basis points. That was because the overweight to U.S. equity and the underweight to Core Plus 5 and TIPS helped. The underweight in the management effect is due to underperformance in the private equity sector. Now, in the short run, it's generally due to timing differences, but as you'll see in a moment, that's not the only story there. On page 11 is the full year. So the 1224 is a very strong return. Same beneficiaries for the allocation effect. We've been overweight U.S. equity, underweight core plus 5 and tips, and you'll see the numbers later, but those overweights and underweights added 82, not added 82, but were effectively the bulk of the 82 basis points that were added. And the management effect, while it looks like almost only minus 15, if you'll turn to page 14, you will see the 12-month management effect. And not only did the overweight U.S. equity help, but Seema's going to talk about a little later that the underlying equity managers also did very well. That shows up in the positive 62 basis points. The core plus 5 managers did well. High yield managers did well. But private equity was almost down 1% versus his benchmark. As you get to longer term time horizons, like 1 to 3 years, and it's the same story for the 3-year number of minus 87, that's no longer just a lag. That is actual underperformance. And it's mostly...
Typo on this page? Or typo on this page?
There is a typo on the page 14 for the quarter. That shouldn't be 1 basis point. That should be 1%.
Private equity.
For private equity, yes. The other numbers are correct. So it's in the short run timing. In the long run here is defined by 1 year and 3 years. It's underperformance. Larry's going to talk about that a little bit later. And for the 3-year number, you'll see the numbers there. The allocation effect was helped by the most recent allocation decisions, and from 1.5 years to 3 years ago, the overweight and cash hurt. Management effect is almost all, actually is all from private equity, and we do have some positive effects in other asset classes that were outweighed by the private equity. So how did NYCERS do versus other large public funds, as we define here, as greater than $10 billion, and that's on page 15. On the left is the quarter, roughly flat in the 60th percentile. The 1-year number, third column over on the left, it should say 1224, not 1222, was just outside the median in the 54th percentile. But you'll notice that the 3, 4, 5, 7, and just curiously, the 4, 5, and 7-year numbers are all in the 29th percentile, safely in the second quartile.
This is not just us, this is the entire system.
No, this is NYCERS. This is NYCERS. Yeah, we calculated each separately for each system. So the return should correspond to the returns you saw on the first page, with the exception of the 1-year typo of the 2 basis points off. So the 3-year number is very good, and also the 4 and 5-year numbers are quite good versus your peers, and also Callum will go into that as well. So unless you have further questions, I'm going to turn it over to Seema.
Okay, thanks, Martin. If you turn to page 19, this shows your overall domestic equity returns versus the benchmark, the Russell 3000. As you can see, about $18 billion, close to 40% of the total funds. In the quarter, roughly in line with the benchmark, but importantly in the fiscal year to date, just going into a little more detail to what Martin referred to. So nice outperformance relative to the benchmark, but in absolute terms as well. Very strong numbers out of U.S. equities for the fiscal year. The benchmark being up 21%, NYCERS being up 22.75%, and this was due to 2 things, which both worked in our favor. So on the asset allocation side, our overweight to small cap, our overweight to mid cap, and our underweight to large cap really helped us. And at the same time, our active managers added value. So we got the benefit of both things in this fiscal year. Just to give you a sense, so the small cap index was up 24%, and NYCERS small cap was up 27%, so 300 basis points of outperformance. The mid cap index was up 25%. We have no active managers in mid cap, but again, relative to the Russell 3000, 25%, 21%, 400 basis points of outperformance. So our overweight there helped. And then in large cap, the index being up 21%, and the NYCERS portfolio was up 25%. So our active managers added 400 basis points of value there. So things work well for us in the fiscal year. So if you turn to the next page, this is a U.S. breakout just for the quarter. As you can see in the pie chart here, about 75% of the money is passive. And I'll just point you to a couple columns, the index return, the actual return, and the difference column. And again, as Martin mentioned, the U.S. markets, you can scroll down to the Russell 3000 index, up almost 3% in the quarter versus the international markets, which were down. Again, I'll point you to the difference column. You can see here that in the quarter, most of your active managers did add value. If you then turn to page 27, go to international. So about $7 billion, about 15% of the funds. And if you look at the pie chart to the left, it's kind of opposite to how we're positioned in the U.S., where 75% of the money here is run actively. And if you look at those three columns, the index return, going back to what Martin said, so EFA passive down about 1%, and then EM down a lot more, down about 8%, again, versus a positive number in the U.S. And if you look at the difference column here, you can see that most of the active managers also did add value in the quarter. If you then turn to page 28, the next page, there's a little more detail on EFA. So EFA is about $4 billion, 8% of the funds. And if you look in the trailing 3 months, the purple bar is the active, the yellow bar is the index. So our managers had a tough time in the quarter. The fiscal year to date as well, you can see behind the benchmark. But you might remember that we finished our EFA search, and those managers with all the contracts signed only hit as of May of this year. So we should start to see the benefits of having our new managers going forward. If you then go to page 35, it's emerging markets. Here close to $3 billion, about 6% of the funds. If you look in the trailing 3 months, roughly in line with the custom benchmark. But if you look in the fiscal year to date, again, the purple bar being our active managers, the yellow bar being the index, really nice outperformance, about 200 basis points of outperformance. And you might remember our new emerging market managers that the board approved had almost that full year, so it's good to see that those managers, those new managers, are adding value. If you then turn to page 36, this is the next page, hedge funds. So about $1.5 billion, about 3% of total funds. The approved allocation is 4%, so we're making our way there. So to point out, in the trailing 3 months in the quarter, we were going into the month of June looking really good, and then we had a really tough June where we were down 3%. And so, but if you look at the fiscal year to date, we show some good numbers here where on an absolute basis, we're at a net 8.6%. Relative to our two benchmarks, we're outperforming. And basically, we're hitting all of our targets that we had set out for the hedge fund program so far. So with this 8.6% net return, we're hitting our volatility targets, our risk targets. So we did that performance with about a 4.5% volatility, a 0.14 beta to the S&P 500, and a 0.4 correlation. So we're all kind of within the targets that we wanted for the program. So far so good. We still have more to go, but so far so good. If there aren't any questions, I'll turn it back to Martin.
Again, you referenced net returns, but this is still gross.
This is net.
This is
Hedge
net.
funds net.
So hedge funds are net,
All the
public
markets.
equities are gross,
Correct.
and
public fixed income.
And public fixed income.
Are
Gross.
Opportunity fixed income.
We do have a chart in the end. We do have a
of
chart.
course
In
it
the,
is.
there is a chart.
Because
In
it
the,
carries net. Right. That's a simple way to look at it, sorry.
But you could do public equities net, right?
With a new bank.
that's the plan. That's the plan. And just for your knowledge, there is a chart in the appendix that show what the fees are by asset class. unfortunately.
I just didn't want to do the calculation.
Right, exactly. So going forward, we expect to have that in this report.
Okay.
Seeing that it appears as though, except for one area, that the active managers do very well from this. Is that correct?
That's right. It's good.
And just from a policy standpoint, we're completely passive mid-cap and not active. Is there and that's an area where we're active with small and mid-cap, are you going to be passive, more passive large cap? But just curious on that.
Yeah, that was a board and Callan in our conversation, and we do have some good, we think, mid-cap active managers, but at the time, as we were putting together the asset allocation across the three, the board decided to stick with mid-cap passive. Something we certainly can revisit. We can certainly revisit.
But again, these are full process.
David, maybe to add to it, at that point, you had a small cap active program, a small cap search was already underway. You had really no mid cap managers at all without a search being underway, and so to some extent, the overweight to mid cap, which was, as Seema said, appropriate and has worked out well, was a default to passive because that's what was available at the time. But you're right. I think our analysis would also show that active mid cap is a source of active management very frequently.
All right.
Yes, so on page 38 shows the total fixed income allocation. It's about 30% of the assets, $14 billion, and the largest allocation is the Core Plus 5. On the next page, we break down the Core Plus 5 into its three major components. And a key feature that I've been showing the last few quarters, and I want to show again this quarter, is on the bottom chart, looking at the under overweight column, and you'll see we're underweight what's labeled Treasury Agency, the government sector, and overweight the spread sectors. If you look at either the index return or the actual return column, you'll see during the month of June, because interest rates went up, the biggest loser were the government bonds. So being underweight the worst performer added 8 basis points of allocation. As far as the managers themselves, of the 15 managers, 9 did outperform. Most of the underperformers came from the government managers as well as the mortgage managers, as they were trying to deal with the duration and the changing winds going on in the marketplace in May and then in June. But overall, for the year, as you'll see, things went well. And by the way, for the one-year number of 14 managers, 12 outperformed, and in 3 years, only 1 did underperform, and that was only by a few basis points. So the programs work very well, as you'll see on page 40. When I say well, for the quarter, unfortunately, well has a minus sign next to it. So the returns were minus 284, was ahead of the policy benchmark, 4 plus 5 index of 291. For the fiscal year to date, and this is very important, the number looks very, very modest and very small of 33 basis points, but in a very low return environment, outperforming by over 125 basis points is very, very, very helpful, given that the benchmark was negative almost 1%. And this is where the overweight to spread sectors, as well as the managers that I mentioned to you before, the 12 and 14 managers outperforming, helps. The 3-year number is positive, just shy of 5% ahead of the benchmark, and the managers and programs are ahead of the benchmark. For the longer term, generally in the 5.5% to 6.75% range for the Core Plus 5. Tips are shown on page 41. These are some of the worst numbers that you'll see for the quarter, and that's because these are pure interest rate plays, and tips have very long durations, but they're real rate durations, and real rates have been rising dramatically, and did rise dramatically, specifically in the month of June, but also in May, to the point that the returns were minus 7%. And for the fiscal year, were minus 4.5%, although it was ahead of the benchmark. For the 3-year number, the return is positive and ahead of the benchmark slightly, and the return is 4.70. Similar returns for the 5-year number, and 5% returns going out 8 years. We'll have a 9-year return soon. High yield did very well. Doesn't look like that in the quarter because, again, it was negative, as most asset classes were negative, minus 130, but that was ahead of the benchmark for what it's worth with a negative return, and that, for what it's worth, is important because it adds value in a negative environment. But if you draw your attention to the fiscal year date or 1 year columns, you'll see that the returns were 200 basis points ahead of the benchmark. That's primarily due to, we had a transition a year ago, everything's fully funded. Your most aggressive manager, Loomis Sayles, as you might expect in a bull market for high yield up until the very last month, did extremely well. You'll see that in the appendix. And your largest manager, T. Rowe Price, which we would define as a core manager, also did very well during that time period. In the last month, your most defensive manager, Schenkman, outperformed, as you would expect they would. And the long-term results, you'll see 3 years, 5 years, 10% returns, even out to 10 years, over 8% returns with nice outperformance. So the program's done very, very well. Convertible bonds on page 43. Positive numbers for the quarter because of the equity correlations. Behind the yellow benchmark, which is the policy benchmark for convertible bonds, the purple benchmark is the weighted average of the managers, and what that indicates is the managers outperformed their individual benchmarks. The program benchmark is a different benchmark, and what you'll see is for the fiscal year to date, while strong absolute returns, they did outperform their individual benchmarks but underperformed the overall market. That does smooth out over time, as you'll see. As we now have a 5-year record where the blue bar, yellow bar, and purple bars are converging. As you know, we terminated the manager within the last 6 months, and part of the underperformance of that 5-year period was due to that manager. So that will mute over time, we hope, as long as managers continue to outperform, and they have been outperforming. Opportunistic fixed income has been the star in fixed income, and we'll talk about this later in the agenda. For the quarter, returning a very strong 367, and for the year, over 16%, and going out 5 years, over 12 3/4, almost 13% ahead of the policy benchmark. And we'll, again, like I said, we'll talk more about this later. The next 2 pages show the developing manager LM on page 45 and progress emerging manager on page 46. Similar story to the Core Plus 5. Good results for the year, negative returns for the quarter, and very good results longer term. Unless there are any questions, I'm going to turn it over to David Morris and Chris Pack for EPIs.
Good morning. I'm David Morris. I'm the Executive Director for the Bureau of Economic Development. As many of you know, Kathy Martino retired last month. Kathy has been working for me in the last year and a half. Sitting to my right is Chris Pack. Chris will be assuming Kathy's functions, and you'll be seeing Chris as we go forward. For the past quarter, ETI outperformed its custom benchmark by 1.77%. And in the past year, ETI beat its benchmark by over 4%. The PPR program performed well in the second quarter, also beating its benchmark. In this quarter, PPAR, the NYCERS purchased over $19 million worth of loans that will create or preserve over 1,400 units. NYCERS also made new commitments for roughly $70.8 million, and that will cover 2,459 units. Overall, PPR market value is currently $216.9 million. I would just like to take a moment and highlight one of our new investments, which is the MS Real Estate ETI Fund. MS made its inaugural investment in the second quarter.
By the way, there's a page in the book, I think maybe 13 or so.
Yes, I'm referring to...
In the large book, the white pages.
Yes, page 13. Fund purchased a commercial building on Flatbush Avenue in Brooklyn, and the NYCERS share of that purchase was $5.6 million. Already, the The investment has preserved 22 jobs and has already created 10 new jobs and is anticipated to create an additional 5 new jobs when it's fully rented. Currently, tenants include Carver Bank, 7-Eleven, Blank Fitness, and AT&T. Any questions?
Liz?
Yep.
Thank you.
So I'm starting on page 19 of your bigger booklet. So this is the quarterly report for the private equity portfolio ending first quarter 2013. So you'll see on page 19 that as of the first quarter, you have $6.8 billion committed across 145 funds, which represent 95 relationships. Net contributions for the quarter ended at $4.6 billion. Cash coming back to you in distributions was $2.4 billion. Market value is $3.6 billion, which gives you a total value of about $6 billion in your portfolio. Total value multiple for the quarter end was 1.3 times, and the IRR stayed the same as the previous quarter at 8.5%. So if you turn the page, you'll see how you performed against the benchmarks. You'll see that against, in the bar chart, against the Russell 3000 plus 300 basis points, you underperformed. They came in at 11.4%. But then against the Thompson 1 median IRR, you overperformed, where they came in at 4.2%. And if you turn to page, one second, I'll make a note. If you turn to page 30, you see some of the deals that we did, that we closed on the quarter end. So the table below, you'll see that we closed on 3 deals. It's actually 2, but 3, $111 million. One was in Landmark Equity Partners 15, which is a secondaries fund, and we also were able to get in and create a co-investment vehicle there as well. And then Acon Equity Partners 3, which is a small buyout out of your emerging manager program. Then you look below and you'll see the 7 deals that we closed subsequent to the quarter end, which represents 3 core relationships and 4 emerging manager relationships for a total of $389.6 million. Then if you turn to page 33, you'll see what strategies are working for you, which are performing really well for you. You'll see on the bottom table, you'll see the top performing strategy for you in your portfolio in the quarter end was secondaries, where they came in at 16.4 IRR. And that's led by some great names that you have in your portfolio, like Landmark, Lexington, AXA, which was a new relationship for you. And then you'll see right behind that with special situations that came in at a 16.2 IRR. And that's really led by great deals like Ares and a new relationship like Platinum. And then followed by growth equity, which came in at 15.3%, and that's really led by great deals like Vista and Warburg, which is a new relationship for you all. And then the last would be buyout, which came in at 9.5%, and that's led by some great deals that we've had an existing relationship and just re-upped with recently, like Apollo, CVC, and Carlyle. So if you turn to page 37, I'll leave you on a very interesting page because basically shows the cash coming in, cash coming out on a quarter-by-quarter basis. And so you'll see the top bars on the bar chart is the distributions coming in, the bottom chart of the contributions going out. So you'll see for the quarter end, you have contributions of $103.2 million, but you got cash back of $124.7 million, which gave you a nice net cash flow of $21.4 million. So that's it for the first quarter report for private equity.
This overall comments on the private equity portfolio is from 30,000.
From 30,000 feet, it's not performing the way it should. It's the biggest hanker, it's the hardest to change. We've done a lot of work to change it, which I'm going to go through with you in executive committee. There's a number of poor funds that we have that are a drag on the returns. So if you look at the return on page 33, the net return is 8.5%. And if you listen, remember what Martin said, the quarter, 1 year, and 3-year numbers all lag. And if you had something that was closer to what you'd expect, the whole fund would go from sort of median performance to right at the edge of top quartile performance. So it's a long-term project. We've taken great strides at it. And I'm very optimistic about the future. But again, the returns are going to come in 4, 5, 6 years. In the meantime, we just need to have the bad funds, if you will, the underperformers or the underperforming sectors, run off, which will take 5 more years. Thanks. Yvonne?
Okay, for real estate, last time we met, we talked about, actually, the handout was a handout for real estate, it's color. Just wanted to share with you the new format. We talked last time we met that a change was underway. Thank you, Ray, for reminding us. So just wanted to take the opportunity to introduce you to this new format. Hopefully, we'd love to get some feedback and input from you. Of course, we tried to make it more user-friendly. This first page has a lot of information about your portfolio at a glance, particularly the left margin that's colored in blue. In the following pages is more detailed on portfolio construction, what's driving the performance in the portfolio, which strategy, which investments, and there's also more information on performance and also on the market. But I'm just going to give you the highlights of the first quarter 2013. So as you know, that there is allocation to the real assets of 6%, and that would equate to about close to $3 billion, $2.8 billion. The real estate portfolio has a market value of $1.9 billion. We have about $500 million, $500 million that we've committed, but we've yet to fund, and overall the exposure to real estate is $2.4 billion. And we invest in real estate with the help of 27 managers. We currently have close to 40 investments at this particular time. And so we are 4.2% funded in real estate. I'll take you through the performance. So if we kind of look over to the bottom right of the page, you'll see the performance of the NYCERS real estate portfolio versus its benchmark. The benchmark, as you know, is Odyssey with a premium of 100 basis points to reflect the fact that we have a portfolio of both core and non-core strategies. The NYCERS performance is in blue. The benchmark is in yellow. And as you look over to the right for the longer periods, you see how the portfolio have been impacted by the global financial crisis. We ran through a rough patch. You can see that in the 5-year and the since inception. However, since inception date for NYCERS is probably about 03, 04. I'll confirm that for you. So as you can see, as you go over to the left for more of the near-term performance, for the quarter, the NYCERS portfolio is right on top of the benchmark, again for the 1 year as well, and an outperformance of 260 basis points for the 3-year period. So we're moving in the right direction. In terms of portfolio, again, we've been able to make some new commitments, and we made 2 new commitments during the first quarter to 2 Sandy-related investments for a total of $125 million. And now that we're in September, just to kind of update you that we subsequently closed 2 other investments, Emerson KTR, for a total of $225 million in commitments in the first and second quarter. And so just to kind of flip over to the next page, you'll see that on the bottom, page 2 and page 3 gives you more information about your portfolio, what percent is core and non-core. We're certainly within the bounds. We talked about the cash flows that's between NYCERS and its managers. And for the first quarter, actually, the distributions outpaced capital contributions, and that's because we had some very active debt managers who monetized some investments during that quarter. On page 3, this is a new page that talks about the performance of each component of your portfolio. So the first component deals with the core. So we have 11 core funds that were able to produce a quarterly return of 2.5%, being driven by PRESA 2. With respect to the non-core portfolio, you have 25 non-core funds there, and they were able to produce 3% for the quarter, and the leader there was Blackstone. And the graph at the bottom just typically just kind of shows you how each strategy performs. The following page shows you, again, more detailed performance information. So as I said, take a look at it. Send me some emails, and when we go through this performance, again, next time, I hope to be able to shape the conversation, more to what you want to hear about. Anyone have any questions? Thank you.
Yes.
That's one.
So our report begins on page 57 in the large board package, but we're also handing out a color copy. A lot of material that I will cover has already been discussed, but we are looking at a little bit of different time periods. And this is sort of a summary of the Callan performance report, the quarterly report that gets mailed to you. And so I'll walk you through it. Starting on page 2 of the handout reflects your asset allocation as of the end of the quarter versus the target. And as was mentioned before, you're overweight to domestic equity, underweight to fixed income, and underweight real estate. We developed the interim target benchmark based on where you were as of 9/30/2011. That was 1 quarter after the new asset allocation was developed. And so this interim target reflected where you were on an actual basis for your long-term target, and then compared that to your long-term target, and then it placed those assets into the holding asset classes. For instance, real estate was funded at that time of 3.7% when the long-term target was 6%. The difference was 2.3%, and that was split evenly between equity and fixed income. So that's how we developed the interim target. Page 4 shows the attribution analysis for the quarter against the long-term target. As Martin covered, the fund was down 13 basis points against the long-term target, which was down 9 basis points. And the difference in numbers between what Martin showed you and what we're showing is that we hold the private equity benchmark to be even with itself, just to eliminate the noise that can come out of attribution analysis when we look at comparables in private equity. So with that in mind, what helped and what hurt? What helped was the overweight to domestic equity, the underweight to the core plus 5, and the underweight to the tips from an asset allocation point of view. Also the underweight, those are what helped. What hurt was the underweight to opportunistic fixed and some weak performance in international equity and hedge funds. And really the international equity underperformance was a result of the overweight that we have to emerging markets compared to its benchmark.
And may I just interrupt you for a second? When you talk about overweights and underweights, it is still within our policy range, correct? We're not violating any sort of policy, we're still within our range. So what you're really saying is that we're either at the high end of the range or at the low end of the range, but still within
Yes,
the range.
but the first page 4 is the comparison to the long-term target, and then page 5 versus the interim target. So there's really 2 different targets that we're looking at.
But still all certainly within the board's policy.
As Martin covered, there was an outside boundary of the TIPS allocation, but it is a slight violation of the boundary.
But that's been corrected.
it's in the process of being corrected.
So the core plus 5 is slightly below. As we said last month, we have a few hedge funds and large real estate deals that will be correcting that. We are overweight U.S. equity. Beyond that, Larry will talk about August. Markets kind of self-corrected that, but also new funding will come out of that. And TIPS is slightly below, and we have not taken steps to correct that at this point. And we can talk more about that if you want, but at this point, after talking to our consultants and looking at and talking to our managers, the slight underweight that we have beyond the rebalancing range, given where real rates are and the high duration and the likelihood of volatility of rates, it was a decision that we did not think it was appropriate to put the fraction of 1% into TIPS, given where the markets are right now and given the Fed statements that rates will be rising. Real rates rising will hurt TIPS.
And so the TIPS allocation is outside of the boundaries of both the interim ranges and the long-term?
We only look at it versus,
I think it's balanced. So
after August, it would be very close. Yeah.
Okay, all right, good.
Larry's going to go through that, but after August, it's very close.
Okay, thanks for clarifying.
So page 5 shows the total fund quarterly attribution versus the interim target, and it's basically the same analysis. The only difference being that the interim target was more negative than the long-term target, but the same reasons for what helped and what hurt. Page 6 looks at the attribution starting with September 2011. So we're building this longer-term attribution, and this is, so it goes back 1 3/4, which does not equate to the time periods that Martin had shown. And you see that the total fund performance was 1397. The target return was 1359. And over this 1 3/4 year period, what helped was the overweight to domestic equity, the underweight to core plus 5, TIPS, and hedge funds, and then strong manager performance in domestic equity, core plus 5, and real estate. What was a slight drag to performance was the overweight to short-term cash and private equity, and underweight opportunistic fixed, as well as some poor performance in the opportunistic fixed, international equity, and hedge funds.
Hey, Bud?
Yes.
So hedge funds helped and hurt?
For the quarter, being under-allocated helped because the performance was negative in the quarter.
But the hedge fund performance was slightly below benchmark over the time period. Page 7 has the 1 3/4 year attribution versus the interim target. The interim target did not perform as well as the long-term target, and so the outperformance is likely better. And similar reasons for what helped: overweight domestic equity, underweight core plus 5 and TIPS, and the strong performance in domestic equity, core plus 5 in real estate. And then what hurt was the overweight to cash and private equity, and weak performance in fixed income, international equity, and hedge funds, opportunistic fixed income. Page 8 and 9 have comparisons to other large public funds in the Callan database, so it's a little bit different than what you saw with Martin's comparison. But similarly, the direction of the numbers are the same in that the last quarter and last 1 year are below median versus the peer group. And the main reason for that has been mentioned is the mediocre private equity and hedge fund performance, as well as the overweight to emerging markets when emerging markets performed poorly over the last year. So that was a drag on performance, and you see the 65th percentile. Longer term, 3 and 5 year number is above median, the 43rd and 25th. Page 9 does an asset allocation adjusted ranking. So it says, what if everybody in the database had the same asset allocation as NYCERS? And so it gets at more of how your managers have performed in the aggregate and strips out the asset allocation effect. And so you see the performance has improved over all time periods when you look at it on an asset allocation adjusted basis. Page 10 has the total fund peer comparisons on a calendar year basis. And although you are in the 65th percentile over the last year, going back over the calendar years, this year to date is the only one where you're below median over the last 5 years. You have to go back to 2007 since you were below median. And the risk-adjusted numbers at the bottom of the page are all median-like or below when it comes to tracking error versus the total fund benchmark. Page 11 looks at total domestic equity, which was covered by SEMA earlier. You see better performance than the benchmark over the last quarter and last year, 2 years. 3-year number is pretty much benchmark-like. The benchmark is the Russell 3000. Page 12 shows it on a calendar year basis, as well as the risk-adjusted measures, which are all very median-like. You would expect that with high allocations to passive. Page 13 just strips out the active domestic equity managers, and you see the performance is much better, mainly as a result of the fundamental index managers performing very well, and as Seema mentioned, a slight overweight to small cap. But the last year was a very strong third percentile within the database. Page 14 has more risk-adjusted numbers as far as the total active domestic equity. You can see strong alpha information ratio. The tracking error is higher than average tracking error since 2007. However, you've been compensated for that higher tracking error over that time period. Page 15 is the total international equity composite. Underperformance more recently as a result of the overweight to emerging markets, which has been a headwind the last year at 1193 versus the benchmark of 1414 in the 80th percentile. Longer term numbers, as we've had some manager issues, has been below benchmark, but as Seema mentioned, we now have newer managers across the lineup. Page 16 shows it on a calendar year basis. The last 2.5 years have been below benchmark. 2010 and 2009 were stronger years. Page 17 strips out the active international, but I want to point out that this composite does not include the emerging market active managers. BNY is going to set up a new composite for us, and the new custodian will also do that. But right now, we're only looking at the active EFA managers in this composite here. And so you see a little bit better performance versus the benchmarks and the peer group over the quarter 1 and 3-year numbers being median over the last year and above median over the last 3. And finally, page 18 has the tracking error for the active international, which is below the peer group. The green line is your portfolio. The red line is the median of the peer group. So you have very low tracking error versus the benchmark. Starting on page 19 is looking at the total fixed income. So this is core plus 5, this is high yield, this is opportunistic fixed, tips, everything within fixed income compared to the fixed income target. It was slightly better for the quarter. The numbers here for the fixed income against the peer group have been strong. More recently, the overweight to high yield and the underweight to tips was positive. The underweight to opportunistic fixed was not positive over the last quarter. The 3-year number being below the benchmark, as Martin has mentioned in the past, there was underperformance mainly in 2011 in high yield and opportunistic fixed that brought down that number, but still against peers, it's very strong. Page 20 has the calendar year performance for the fixed income portfolio. All relatively good performance numbers except for that year 2011, as I just mentioned. And then page 21 has the tracking error numbers. It does reflect that tracking error was a lot lower than the peer group up until recently, as we started adding some more active managers. That has come up, but it's still in line with peers. And then 22 and forward are showing the same analysis against the interim fixed income benchmark, because again, we are underweight the opportunistic fixed bucket, so that has been, there's an interim benchmark for just fixed, and you see that that benchmark is performed worse than long term, so your comparisons look a little bit better.
Yeah, Bud, could you comment a little bit on the bond portfolio and to what extent the duration of our overall fixed income portfolio differs from the benchmarks, and to what extent that has helped or hurt?
It is, the NYCERS portfolio has a relatively longer duration than most of the plans in our database. Our database is looking at public funds greater than 10 billion. You know, if we were looking at corporate plans with longer durations, then it would be closer, but most public funds don't have the longer duration that we do, and that has helped long term. More recently, when rates spiked, it has been a headwind, but longer term, over the last 10 years, it has helped performance.
It's my understanding that the difference between our duration and the benchmark duration has shrunk over the last 10 years as the composition of the index has changed somewhat for the Core Plus 5. Martin may know.
You're comparing the Core Plus 5 versus what? The Barclays you're talking about?
Barclays Ag.
Actually not. And the reason because of that is because of the enormous issuance of government debt and the enormous amount. What happens is the 1 to 5 year treasuries and agencies, there's been huge issuance of that at virtually no yield. And so our benchmark removes that. So while Bud is correct, we have a longer duration, but we also have a higher yield. I also want to point out that while we do have a longer duration for the Core Plus 5, compared to most other plans, we have more high yield and opportunistic fixed income, which have much lower durations, also convertible bonds, which most other plans don't have. So taken together, while the Core Plus 5 does have a much higher duration, the fixed income portfolio, the other elements do help mute that. And over time, yield does win. In the short term, it can hurt the duration, but over time, that 40 to 80 basis point advantage can help. Because the Barclays Ag includes those 1 to 5 year treasuries and agencies, which have very little yield, there has been a significant difference in the composition underlying of the benchmark.
Do you have any kind of a estimate on the difference in duration at this point?
I have our duration. I don't have the Barclays duration, so unless you guys have it, I can tell you what it is.
About 5.5.
As of the end of June.
So you're saying Barclays was about 5.5?
Yeah.
Well, I have the number right now as of the beginning of September, and ours was 6.5 years.
Thank you.
I have a question along the same lines of risk exposures. Is there a way that you can provide us with the portfolio's risk exposures versus the benchmark using a regression analysis? I know you don't receive our holdings, but does your system have the capability of providing us with some sort of a heat map with regard to the exposures in the
Yeah, we're working
portfolio?
on getting something in place to show you in the future.
Oh, that would be great. So could we expect that maybe?
We're hoping for the next quarterly summary that we provide.
Okay, that would be terrific. And then the other thing that I'm curious about is how our Sharpe ratio thus far with our new policy portfolio, as well as the actual implementation portfolio, how that compares to what our expectations were when we put the policy in place. Do you have a sense of that, or would that need to be something that you go back and take a
Yeah,
look?
I don't know if we had a expectation on Sharpe ratio when we put the plan in place. I would have to look back and see what those projections were, if any, in comparison to where we're at.
I think we would have had a standard deviation expectation, correct?
Yes.
We did, we're operating under a lower vol than the plan.
Yeah, Janice, I'm trying to think back to the asset allocation presentation that we did. And my sense is we probably would have, I know we were showing expected Sharpe ratios for individual asset classes, to what extent that carried through the total portfolio. My guess would be we might have, but I guess I'd also go back to that being a particular point in time. So my guess is we probably had something, we may be able to dig something up, but I didn't have to take a look.
Yeah, that would be great. I'm just trying to think of more ways that we can introduce good risk analysis into these quarterly reports, because we tend to focus a lot on return, but the risk discussion doesn't seem to be happening. So that would be helpful. And anything else you can think of as well.
I'd also like to add that the outperformance of the fixed income portfolios compared to the last 3 years' significant reduction in volatility, notwithstanding the last few months, would have improved the Sharpe ratio of the portfolio. We'd have to look at what it was in 2011 prospectively.
Any other questions for Bud?
Okay, so that ends the review of the year. Just to take a big step back, so we made 12.2%. Target was 7, so it's $5 billion of additional value to NYCERS for the year. So that was a good year. That year's over, so now we're back to start with 0. So if you turn to page 34 in your monthly book, I'll quickly give you an update on the month, and maybe a glimpse into next month, or August as well. So in July the markets recovered from June. June was a mess, you may recall, was a mess because Ben Bernanke introduced tapering probably in the second week of April, and the markets were just a mess in April and May. And then the Fed sort of got the word out that, it's not the end of the world. Everybody pay attention a little more. So there was let's call it a relief rally in July. So if you look on page 34 on the far left-hand side are the month numbers. The first block is U.S. stock market. Basically, the U.S. stock market was up 6% in the month. That's our biggest asset category, so we'll be off to a good beginning. The next bunch of numbers are international. You can see again, EFA was up 5%. Emerging markets are up 1%. Treasury markets were still down about 1%, and the high yield market was up 1%. Just so you don't get too happy on the July numbers, if you take a look at the next page, which is page 35, we gave back about half what we made in July in August. So again, if you look at the first block of numbers, the U.S. stock market was down about 3%. EFA was down about 1.5%. Emerging markets was down about 1.5%. Treasuries were down about 0.5%, and the high yield market was down about 0.75 points. So again, we're going to go through some great numbers in July. Just remember, probably take about half of that off for August. So if you go to page 30, you can see how we're allocated. Again, the way we made so much money last year was over-allocate U.S. equities, under-allocate U.S. treasuries and tips, which is exactly where we left it. Because the stock market was up so much in July, we went outside the range, we didn't do anything, and sure enough, in August it came back in the range. If you go to page 36, you can see the combination of all those good things in July. In the first column on the first block of numbers on the left, we made about 3% in July, which is a great way to start. Again, we gave about half of that back in August. We picked up another probably 0.5%, another couple of points in September. So I'd have to guess probably where we stand now. We're probably up 4 or 5% for the year, which is pretty good, sort of almost a quarter of the way through. We're up over 4%. So we shouldn't annualize it, but it beats being down 4% for the first quarter of the year. So if you go to page 27, this is the 12-month size of NYCERS corpus. At the end of July, it was about a little less than $48 billion. It went down in August. We're now back in excess of $48 billion and heading north. Speaking of north, if you go to page 28, you get the Bob North number. The 10-year return is 7.7%, makes Bob smile. As David mentioned, it's a little gross and a little net in this number, so probably take 30 bips off, and you get to about 7.4. Again, for 10 years is over the 7% net target that we have. So that's a quick thumbnail of where we stand in July, and a quick glimpse into August as well as September. So far so good. Just as a preview into a little bit of the future. So the Fed surprised everybody last week by, again, it goes back to April when the Fed said, hey, we're going to think about tapering. People got comfortable. People expected last week they were actually going to start, and they all said, well, not so fast. So we have a lot more volatility in the last 3 or 4 trading days than you would have liked. You really have to read those guys' lips really, really accurately. What they're trying to say now is they're just not sure. So that'll be volatility, but ultimately tapering is in our future. And I would tell you that the economy is slowly on the mend, so that's all ultimately good. So again, it's right to be over-allocated equities. It's also right to be under-allocated fixed income, particularly treasuries, because the Fed's trying to tell you not quite yet, but ultimately they're going to raise rates. So that's July. Any questions in July? Great. Next thing on our agenda is the IPS conforming update. I think Catherine's going to hand something out, then I'll say a few words, and then we can talk about it.
Thank you.
This might be the only board. This might be the only board that I'm aware of where we have a physics PhD handing out paper, but I'm sure he can handle it. I'm honored.
Thank you. This is much easier to read.
Yeah.
I tried to read it. Black and
Too hard.
all the changes in black and white were much more difficult.
Are we set? Yeah, we good to go or not quite? Not quite. Okay, so we have an IPS that's just about 9 years old. Having said that, the board has passed all sorts of good things, which Catherine's going to walk you through in the past 9 years. And if you've actually been paying attention, you have the old IPS and a bunch of things to add to it. So you have a lot of loose paper, which over 9 years, maybe you kept it all, maybe you didn't. So we decided the simplest thing to do was let's not rewrite the IPS. Let's just put it all in one place and have a couple of conforming changes. which are, again, no policy, just a few words here and there, making reference to certain things, and then have something, which is now your new IPS, which has every piece of loose paper in the last 9 years put in one place. And hence, it's now amended through the end of the fiscal year, which is perfect. So, Catherine, you want to talk about the big picture stuff that we did?
Sure, I just want to underscore, this is a good housekeeping matter. And if you turn to page 31 in the handout, the colored handout, the red line, or page 236 of your book, the big booklet, there's a summary of the material changes made to reflected in what's been passed out. So the primary modification is the asset allocation, which was approved in December of 2011 by the board. This also shows the date or dates at which these changes were made and adopted. We've adopted a series of new IPSs for the alternative asset classes, private equity, real assets, opportunistic fixed income and hedge funds. That's reflected here in the list. And there have also been some legislative changes, which we've noted through the document. One is that we've gone to 7% net from 8% gross per Bob North. That's been resolved here. And we also had a change where we can go to up to 10% in real estate without triggering an effect to the basket clause. So those are the primary changes. Any questions?
So there's no policy change or anything in this document. It's really just, the key word here is conforming, put it on one place, and make it much more user-friendly for everybody.
Yeah, but also, just as a note, Bud from Callan also noted a few things that we missed in those conforming. They are form over substance as well, and so we had some misses in the
So
copy.
we're going to take his and recirculate the final?
Yes,
Okay.
we'll take care of that today.
Greg, did you have a question?
Just a polite recommendation, even come January, we might see a lot of new faces. This is the kind of thing that should be distributed as part of a welcome packet to people who are being onboarded, given the amount of turnover we're going to see. And hopefully, as we wrap up 2013, we can start talking more about things we might want to do to welcome the any new trustees that come on first quarter.
Good suggestion. Thank you. Catherine, I have a question. We've also made some decisions with regard to granting discretion to BAM in certain cases. So, for example, co-invests for real estate and private equity. There were decisions made to grant BAM discretionary authority under certain circumstances to make that change. We also have a discretionary emerging managers program now. And then I think we've also granted BAM some discretion with regard to the real estate program, whereby decisions, and I don't remember what it is because I can't find it written down anywhere. Isn't there also some discretion with regard to the real estate program where re-ups under a certain dollar amount in either a core or non-core, I can never remember which, actually don't need to come to the board for approval? And it's hard to keep track of all of these things. So I'm wondering if a policy document is the best place for that, or where else can the board or a new trustee coming on board in January find that sort of information?
We'll make sure that they're in whatever's handed out for the new board. We'll make sure that they're there.
So as part of the policy or some separate documentation?
Maybe some separate documents. You have to go asset class by asset class. There's certain little things. Make a list. I think you probably get most of them. But let us go think about what those little things are.
Yeah, that would be really helpful because I myself forget, and I was here for most of them, but off the top of my head, it's hard to keep track. So.
Okay.
And just want to ask Corporation Counsel, since Inga is here, have you had the opportunity to review this document?
Yes, you asked me about that previously, and I indicated that I believe that the vast majority of the issues addressed here are investment issues, which would be something in your area of expertise as well as that of the controllers. I don't see any legal issues other than the securities litigation protocol, which I noted needed to be updated, and it was.
Okay, terrific. So no concerns with the document. I might also just suggest, or rather point the board to page 29 of the document, the clean document. There's a section called Review and Modification of the IPS. So I do commend BAM for undertaking this update. There were a lot of changes in the past few years, and this will be very helpful to all of us, having these changes made. So thank you very much for doing this on behalf of the board. The thing that I wanted to discuss briefly is that a review of the IPS is also supposed to be performed every 3 years. And it seems to me that this document is back from 2006, which is well before the financial crisis. And it doesn't seem that we've taken a holistic relook at the document since then. And I would suggest that that would be a prudent thing to do, as well as making us in compliance with our policy document. And just a quick question to Callan. What is the norm for Callan clients? Is 3 years a good time frame for us to undertake a review? And have most of your clients done a review since the financial crisis of their policy statements?
I think 3 years is about average, and people do take an annual look at it from time to time. And I would say that the majority of our clients have done a redo since the financial crisis.
Other things that was just mentioned about the big change in the board would be a great thing for the new board to pick up. This is nice and organized. Let the new board, with all the new members, go through the IPS and update it however they see fit. It's a great place to start and understand how it all works.
Would it be something that BAM and our consultant would perform on behalf of the board? Or are you expecting that this would be something that the board would do itself?
I leave it up to the board as to how they want to do it, but I'm sure they work with BAM and Callan to get it done. But again, new board arrives. They have a lot of things to sort through. But I would say, again, since they're new, it's a great living, breathing document to pick up and work their way through.
So just as a consensus of the board, is that something that we want to keep this document in place today and leave that to the board in January to pick up? Or is this something that we want to start working on with the consultants now and have a draft for the new board when they come in January? Anybody have a preference?
I think we keep it and let the new board, when they get constituted, do it. I don't think we should be tinkering with it at this stage, because we have no idea what it's going to look like, and I think we owe it to them to let them put their own imprint on it, whatever that may be.
Someone has survived a couple of transitions. I would tell you it's a little presumptuous for us to decide what the policies of the next board should be.
Well, I think this policy is merely documenting what our current policy is. And to the extent that it's not reflective of how we operate or what our current policy is, it absolutely should be updated for the new board coming in. But I absolutely agree with you guys as well that we should not be presumptuous and impose new policies on a board that's just coming in.
So as far as your comments, I think the next thing that this board should do then, hopefully, is adopt the conforming IPS, so we have that in the books, as they say, and move forward.
Okay, great.
To the next item. So I think we need a motion to, Larry, right? We need a motion to adopt the conforming IPS?
Well, I thought we were going to see some changes based on Callan's comments.
So I think they're edits, so I would say we should adopt this, and then we'll send around the comments for everybody as a final, because...
Can't you just say it's subject to Callan's edited comments?
And you got a friendly amendment, so appreciate it.
So that's, sorry, would you restate your motion?
So with David's assistance, I would say that the board adopt the conforming IPS before you, and tell me if I got this right, David, with subject to receiving which we have, receiving Callan's edits, and we'll circulate that to all the board members.
We'll circulate a red line as well as a fine, just so you see what's in there. But again, they're not very many, they're not very long.
May I ask something?
First, do we have a second for that motion?
Second.
All right,
Yeah,
John?
I was asked to just amend the motion to put the term minor in those changes.
They are minor.
Yes.
It's really a matter
I didn't
of,
want it to mean their comments.
I'm not meeting their comments and making minor editorial changes.
Excellent.
All right.
So we're saying adopt the conforming investment policy statement subject to Callan's minor edits? To be
And for the
circulated or
minor
not to
intro-
be circulated?
circulated.
It will be circulated as the adopted version.
Okay.
Okay.
Any additional discussion on this matter? All in favor?
Aye.
Any opposed?
Okay, it's resolution number 1.
Thank you.
I just in good faith, but I never.
And
Do it
so-
again.
Larry, does that conclude our public agenda? Do we have a motion to exit the public agenda and enter executive session?
Okay.
Did we get a motion?
Motion to exit the public agenda.
Thank you. And we have a second from Pat. All in favor? Any opposed? Okay.